The Friday Reckoning. On Friday the 9th of January, as markets closed for the week, silver did something it hasn't done in a generation in nominal terms. After a week of historic volatility, including an intra-week high in near $84 and a sharp retracement to $73 an ounce, the market settled for the week practically at the $80 mark. Whether the final tick was $79.95 or $80.05 is irrelevant to the long-term observer. What matters is the structural shift beneath the price. Welcome to Money and Power, where we focus on structure, not noise. While other channels rushed to declare a silver crash when prices dipped midweek, what we saw was something far more familiar. A shakeout of leveraged short-term positioning. 10 years ago, we identified silver as a strategic necessity and recommended a long-term purchase approach. 2 months ago, we explained why the floor was rising. Today, we're looking at what the $80 close actually represents. Now, we don't trade the noise of $11 swing. We look at the 800 million ounce deficit, the mathematics of a serious potential for $5,500 gold this year, and the growing systemic risks that are quietly pushing sophisticated capital towards physical metal. Pillar 1, the 800 million ounce deficit. The primary reason silver recovered so quickly from its midweek dip comes down to physical math. According to the World Silver Survey 2025, the cumulative supply deficit from 2021 through the end of 2025 has reached approximately 800 million ounces. That means we've effectively consumed an entire year of global mine production that simply didn't exist. The gap has been filled by drawing down above ground inventories, particularly in London and New York, where deliverable stocks now sit at multi-year lows. This isn't speculative demand, it's structural, non-discretionary demand. Solar energy, despite ongoing thrifting, has become one of the largest single sources of incremental silver demand. The sheer scale of global photovoltaic installations has turned silver into a strategic energy metal as countries push for energy sovereignty. Vehicle electrification remains another steady tailwind. The Silver Institute confirms that EVs consume significantly more silver than combustion engines, often between 25 and 50 grams per vehicle. And that automotive demand continues to rise as electrification expands. And then there's AI and cloud infrastructure. Every high-performance connector, every data center, every advanced processing system depends on silver's unmatched conductivity. Now add one final constraint. Roughly 70% of silver is mined as a byproduct of other metals. Supply is inelastic. Higher prices don't bring new silver online overnight. They simply make the existing physical supply more expensive for industries that cannot function without it. If this is the kind of structural analysis you may find useful, take a moment to like the video. It helps the channel more than you might think. Pillar 2, the gold to silver ratio caveat and $5,500 gold. Much has been made of the gold to silver ratio, known as the GSR, and we need to be careful here. Some point to a historic 15-to-1 ratio, but those levels were the product of 19th century bimetallic systems and government decree. That world no longer exists. The modern historical average, however, sits closer to 60-to-1, and that's where the mathematics become interesting. As gold continues to be re-rated, driven by central bank accumulation and sovereign debt pressures, reference levels in the $5,000 to $5,500 range are increasingly discussed in institutional circles. At a 60-to-1 ratio and $5,500 gold, silver prices around $90, and that is mathematically consistent. Even at a more conservative 70-to-1 ratio, silver still prices near the upper $70 to $80 range. The volatility we saw this week, touching $84 before settling near $80, is the market testing whether silver should be treated purely as an industrial commodity or increasingly as a monetary asset. Our view is that the answer is becoming both. Pillar 3, the bail-in regime and private sovereignty. Industrial demand alone doesn't explain silver's resilience. Another factor is growing awareness of the bail-in regime. Modern banking laws, including the Dodd-Frank framework in the United States and the Bank Recovery and Resolution Directive in Europe, have shifted the mechanics of bank failure. Unlike 2008, where losses were socialized through bailouts, today's frameworks prioritize internal resolution. To be clear, in the United Kingdom, deposits are generally protected up to £85,000 under the Financial Services Compensation Scheme. In the European Union, protection extends to €100,000. But for institutions and high net worth holders operating above those thresholds, cash held within the banking system is legally an unsecured claim. That reality is quietly reshaping portfolio construction. Physical silver is a private monetary asset with no counterparty risk. It cannot be converted into equity, frozen on a ledger, or absorbed into a resolution process. When silver dipped to $73 midweek, it wasn't a sign of weakness. It functioned as a liquidity test that the physical market absorbed. Pillar 4, the global bailiff and the flight to neutrality. There's a fourth pillar that moved decisively from theory into reality this past week. What some are calling, and particularly me, the emergence of a global bailiff mentality. Recent events, including the seizure and control of foreign assets and resources, have reinforced a message that central banks and sovereign reserve managers understand clearly. Control and access are no longer guaranteed. This goes beyond sanctions. It's about unpredictability of reach. As a result, we're seeing a flight towards neutrality. Gold has overtaken US Treasuries as the world's largest reserve asset for the first time in decades. Physical metal held in domestic vaults cannot be frozen, rehypothecated, or seized via external systems. As gold becomes increasingly locked away at the sovereign level, scarcity pressure flows downstream. Private investors and smaller institutions begin searching for the next available neutral asset. Silver, with its dual identity as industrial necessity and monetary metal, benefits from that overflow. This move towards $80 wasn't just a trade, it was a signal. So what's the conclusion? Well, the long play. $80 is a psychological line in the sand, and the market will test it again. We may see further volatility. That's the price of admission in a tightening system. But at Money and Power, we don't fixate on $11 weekly swing. We focus on the 800 million ounce deficit, the 60-to-1 ratio, and the changing rules of bank ownership. The world is running out of cheap and readily available silver, and the global financial system is shifting risk away from institutions and onto balance sheets like yours. In that environment, $80 silver isn't excess, it's adjustment. Now, if you found this useful, please make sure you've subscribed and press the bell sign so that the notifications are on. The next video builds directly on this one. Stay analytic, stay invested. Thank you for watching.